Hello, Happy New Year. Welcome to 2022. This is Mike Foreman with Game Plan Retirement with another episode of Let's Ask Mike. As I'd mentioned in one of my recent episodes, often this time of year, I get a lot of questions on whether or not it's too late to make additional contributions to a employer-sponsored type plan, or is it too late to start one, that sort of thing. And in the past and over most of my career, the answer was usually, yeah, it's too late. But with the Secure Act a few years ago that was implemented, that was changed. Most plans, not all, but most plans can be installed even after the end of the year, especially if they involve or only if they involve employer contributions. So a lot of times it's smaller companies that are taking a serious look at implementing a plan after the year has passed. So once I'm able to answer that question with a yes or no, that it's not too late, or yes, it's still possible, the next question that often comes up is, you talk about these plans like cross-tested profit sharing plans or cash balance plans or defined benefit plans, that sort of thing. What's the real benefit of taking a look at all that? Now, they are all very specific as far as demographics of a company goes. So may or may not work in various situations, but when they work, they really sing. And I want to show some specific numbers today to really show you what I'm talking about. So I'm going to share my screen here. And this is a piece that I have that I can share, that I can send out via an email. It's just sort of a primer on cash balance plans. And it shows some of the various limits and how much more it is possible to put away on a tax deductible basis through these types of plans. So we've got different types of participants of different age groups. Let's look at the age 60 to 65. For 2021, the maximum that someone that age can put away through salary deferral is $26,000, and that assumes that they're able to put away the maximum. One of our other episodes, we talked about discrimination testing, which is the fact that some higher compensated employees may not be able to put away the maximum, but barring all that, $26,000 is the maximum that can be put away through salary deferral with a 401k. Now, with a profit sharing plan on top of or attached to a 401k plan, which a lot of folks don't realize, 401k plans are actually built on the chassis of a profit sharing type plan. So what that means is most plans have the ability to make a pro rata or same percentage for everyone contribution as an employer or profit sharing contribution to an existing 401k plan, even if they've never made one before. You'd want to check your plan document, but I've had many situations where we check the plan document and yeah, it's in there. And often it has a vesting schedule on employer contributions. And if you have that or take advantage of it or add it up until you file your tax return, then you can go up to $64,500 per employee. Of course, the employer portion has to be shared among the rank and file. So that takes some math and some analysis in advance. Now, with a cash balance plan, which can be added to all of these, you can go up to $260,000, and that's based on age. So it's different for every age group. The reason it's so much higher is the concept behind a defined benefit plan, which is what a cash balance plan is built on, is that there's going to be a pension or a payment for life when someone reaches retirement age. So it's much, much higher for someone that's really, really close, because you've got to pay that benefit for all those years, which can be a little bit scary when it's for other employees. But with small companies, when it's mostly for the owner, it can be extremely attractive and can really create some very attractive deductions and whatnot. And so if in that specific scenario, the total between a combination of the 401k, a profit sharing contribution, and the cash balance would allow up to $324,500 per person in the deductible contribution. Now, again, as I'd mentioned before, this is very demographic specific, but we have third-party administrators and actuaries that run these numbers all day long, every day of the week. And in the right situation, it really can be worth the analysis. So just wanted to share that. If you have any questions, feel free to reach out, and appreciate your time and hope to provide some value to you and yours over the over the next year or so through Let's Ask Mike. And again, Happy New Year. Thanks. Bye-bye.